Welcome, everyone. We're just waiting a few moments before we begin. If you can take the time in the meantime to take the survey, we will be sharing the results after. So we'll be starting at 4 o'clock on the dot Singapore time. In the meantime, please take the survey as we will be sharing the results after. Thank you. Welcome, everyone, again. Just hold tight. We'll be starting in a few minutes. In the meantime, if you can kindly take the survey, we will be sharing the results with you after, and also the recording and materials of the event. Thank you. Welcome, everyone. We will be starting on the hour. In the meantime, can you kindly take time to complete the survey? We will be sharing the results with you after the event. Thank you. Welcome, everyone. Just waiting for more people to join. We will be starting on the hour. In the meantime, can you kindly take the survey? We will be sharing the results with you after the event, and we'll also pass along the recording and the materials. Thank you. Okay, good afternoon, good morning, everyone. I'd like to welcome you to the first ARA webinar for 2021. Just some housekeeping rules. We will be recording the event and we will be sharing the recording along with the materials after. If I can kindly ask you to take the time to complete the survey that we've posted up, we will be sharing the results of that with you post the event. I will keep the survey open so that for any late joiners, they can have the time to complete and also give another reminder of that after the session. So welcome again, everyone. The topic for the webinar today is 2021, the year ahead, real estate capital value expectations and opportunities. The moderator for the session is David Kim, our CEO for private funds. He's joined on the panel by Stephen Tang, Head of Value Add Opportunistic Real Estate, sitting in Singapore, who will cover the markets of Japan, Singapore, and Hong Kong. And accompanying him is David Blight, CEO for ARA Australia, and Alvin Liu, Head of ARA China, and Anthony Kane, CEO of ARA Korea. Now, during the course of the webinar, please feel free to post any questions on the Zoom tablet. And as again mentioned before, please take the time to complete the survey. We would like to share the results with you post the event. So with that, I will pass on to David Kim.
Thanks, Jay. Warm welcome to everyone for our first webinar. Little did we know that we'll still be meeting virtually 14 months into COVID, but this seems to be the new norm. Sadly, as of today, we have over 105 million cases globally with 2.3 million casualties. On the bright side, various vaccines are making their inroads into various countries, so hopefully we have an expeditious recovery. As always, we appreciate the time that you have taken to join us. To make the best use of it, we'll try to provide you insights and anecdotes that you can't glean elsewhere from research papers. We'll also share with you our 2021 real estate playbook for Asia and what we're seeing as opportunities despite the COVID pandemic. So if we move on to the slide on Asia Pacific macroeconomic recovery, I'd like to just take a moment before we go into our panelists to take a snapshot of where we are. Obviously, COVID has taken a toll in terms of the transaction volumes, but if you look back at the 2008 global financial crisis, it's actually modest compared to that. Of course, the growth will be predicated based on how the inoculation programs will fare, but we do believe that 2021 will be a year of recovery for most markets, as they're expected to undergo positive growth over this year and next. Recent new waves of the virus in most markets will likely dampen the enthusiasm in the first half, but we expect the recovery to begin in the second half of this year. Now, we all know that hospitality and retail sectors have been the hardest hit, and volume of real estate transactions have dived. But however, we have seen capital values hold firm. And so we would like to take the first part of this webinar to really examine why that's being held firm, whether it's due to the lack of transactions and people are expecting last year's prices, or whether or not the long-term view in terms of discount rates and cap rates haven't changed all that much. So we'll go to each of our panelists and examine that. Then in the second half of the webinar, we'll examine what we believe to be the active investment opportunities in each of the countries. And so without divulging too much, I mean, I think logistics is the flavor of the month, but we do see unique situations in each of the countries that we operate in. And so we'll examine if there are any key takeaways that we have been able to glean in 2020 that should be factored into our overall investment strategies. What are some of the better asset classes that would be resilient? And are there specific opportunities that will emerge as any structural changes occur in any of the real estate sectors? So with that introduction, I'll turn it over to David Blight to kick off the discussion for Australia.
Thanks, David, and good afternoon, everyone. I think let me start with the key themes that prevailed in Australia in 2020. The first and foremost was really a flight to cash flow certainty, that any assets that exhibited long and secure cash flow were very aggressively bid. A real flight to certainty, as we call it. The other thing was several trends that were bubbling along in the background pre-COVID were accelerated and amplified with the onset of COVID, and in particular on online retail spending and working from home. And also following on from the working from home trend emerging, it really gave rise to businesses thinking differently about how they utilise their office space, and this is an ongoing dynamic in the market today, and likely to be a bit of a structural change to office space demand in the future. In terms of capital values, prime office and long WALE assets held up really well in 2020, really reflecting the cash flow certainty and the relatively attractive yields compared with the bond rates here in Australia. Secondary office and, with shorter WALEs and any hint of vacancy have been hit significantly. We're still going through pricing discovery for that kind of asset, but we expect up to around a 20% hit for those assets in the most vulnerable of those assets with vacancy. In terms of retail, the acceleration of online shopping has in turn really hurt the discretionary retailer, and we expect that that'll flow through to valuations in retail of probably about 10% erosion that we've seen so far, and I think more to come in 2021. Conversely, for retail, one of the nuances has been that with the lockdown and people working from home, that's improved the trading conditions for a lot of neighbourhood retail centres, and that in turn has attracted capital to those assets, and those values have held firm. As David mentioned, industrial and logistics has been the main beneficiary of the whole e-commerce acceleration and online shopping, and continues to attract a lot of investment capital. So look, turning to the next point, our expectations for 2021. The underlying theme, I think, is that the current level of bond rates will continue to support the current level of cap rates. And in fact, assets that have the long cash flows, long and secure cash flows, we expect cap rates to firm a little more through the course of 2021. When we look at the REIT sector, we see that the entire Australian listed REIT sector is trading at about a 320 basis point premium to the 10-year bond rate, and that's traditionally over the last 10 years averaged 220 basis points. So we think there might be some reversion to the mean there and some compression. We think there'll be continued pressure on retail, particularly the larger retail assets. Their income we expect to settle at around 80 to 85% of pre-COVID levels, and that in turn is going to put pressure on the valuations. And again, we look at the listed sector in retail as a forward indicator. The retail REITs in Australia were down 26% in 2020, and they're trading at an 18% discount to NTA today. So we think there's more bad news coming for retail. We expect businesses to increasingly re-examine how they use their office space in addition to their overall requirements as this entire remote working trend plays out through the course of the year. What we see in Australia is many businesses actually adopting these remote working arrangements in the current environment. Now, how this changes once a vaccine is distributed remains to be seen, and it's very hard for businesses to currently plan without that vaccine being distributed. The consensus view seems to be here that the workforce has a strong preference to work from home around 2 days per week. And if that continues post-vaccine, businesses will theoretically require less space than they have previously occupied. Countering this will be the need for more generous workspace ratios and additional areas for collaboration. In our view, the net result of all of this, all of these dynamics, would be a reduction in the net absorption in the markets of around 10 to 20% per annum, and we think that might be structural for at least the first few years. That in turn leads to higher vacancies, and we think the net result will be much lower net effective rental growth than we've seen previously. And finally, I think the overarching expectation for 2021 is that any asset with a vulnerable cash flow, with a hint of tenancy weakness, with a permanent vacancy, we think is going to get marked down considerably by purchasers, and vendors will need to temper their expectations. Turning to the opportunities for 2021, we'd really like credit in this environment. As many of you would be aware, traditional banks in Australia have pulled back sharply from corporate real estate lending, primarily for two reasons. There's been a capital drain from their existing clients who are drawing down on facilities to shore up their balance sheets. And secondly, the regulators are requiring a much greater amount of capital as a buffer against real estate lending. And so that really gave rise, and we think is giving rise to, some interesting lending opportunities, particularly for non-bank lenders, where you can get a really attractive risk-return equation for a senior position in the capital stack. So we're exploring those. We think you can achieve high single-digit IRRs. We also expect to see a little bit of distress emerging in the hotel and hospitality sector as the year rolls out. We're also looking for more long WALE asset transactions. We think there'll be sale and leaseback opportunities as corporates tend to look to get the assets off their balance sheet to improve their return on equity within the business. For alternatives, we think 2021 is going to be a big year for alternatives. The alternative sector in Australia is very small compared with other mature markets around the world, and we think this area is set to grow. The primary part of the alternative space, the one that gets most media attention, is multifamily, or build to rent, as we call it here in Australia. Now, we are very supportive of the asset class longer term. We think the demographics are very supportive, and the ultimate cash flows that come out of these assets, we think will exhibit lower volatility and lower structural vacancy. But at the moment, we are a little hesitant. We'd like to see proof of concept. We'd like some tax hurdles to be removed. And we'd also like to see some of the design premium and the amenities, the design aspects and the amenities proven up before we develop a full conviction for this kind of asset class. But we're very interested in it longer term. Next, in office land, with the recalibration of values in 2021, we think in the latter half of the calendar year, we think there might be some interesting opportunities in value add, and that will flow into 2022 in our eyes. And I think those opportunities can be pounced on with groups like ourselves who have the investor operator model, where you can roll your sleeves up and get your hands dirty and manage it and deliver the outcomes. Finally, I think if history is any guide, with the REIT sector trading at such a big discount to NTA, we think there'll be some interesting public to private opportunities. So in summary, that's how we're thinking about 2021. Thank you for listening, and I'll pass you over to Stephen to talk about Japan. Thanks, Stephen.
Thanks, David. I think when you're looking at Japan, there's several factors at play. On one hand, with the 0% interest rates, that has really buoyed the markets, not just from the real estate standpoint, but from all of the various other asset classes. That has helped the Japan economy support in 2020. Now, if you're looking at it from the real estate standpoint, it's really a tale of two worlds in some regards. On one hand, if you look at the fundamentals for office, you saw vacancies start creeping up, market rates were tepid and maybe even coming down in certain markets. But if you look at it from a capital value standpoint, you continue to see cap rate compression. You saw pricing becoming fairly sharp. And I think a lot of this had to do with the fact that when you look at the real estate yields compared to the 10-year risk-free treasury bonds, I mean, that spread is about 2.7% in 2020. Now, if you look at it across APAC and from a global standpoint, that's a fairly attractive and healthy spread. And I think because of that, that really caused, the Japan market, especially Tokyo, to be viewed as a safe haven for a lot of international capital. Everyone knew that, domestic markets in Japan were always very strong, but in 2020, you saw a witness of about 3 times the volume of international capital coming into Japan. And so that's really was a flush liquidity event that supported the markets and so forth. And a lot of that had to do with the government fiscal policies. So the government was very, very reactive in terms of trying to create stimulus packages to support the economy, to the tune of, if you look at the GDP in 2020, about 40% of the overall GDP was as a result of fiscal stimulus packages. Now, we anticipate that that is going to continue somewhat in the current year. Actual real economic recovery, we believe, will probably start to happen in the second half of 2020. But because of these stimulus packages, you start to see a lot of different markets, not just the Tokyo markets, start getting priced sharper and have a lot of attention, but even some of the secondary markets like Osaka and Nagoya, especially on the multifamily side, we're seeing a lot more activity in that particular space. Now, if you look at it from a capital market standpoint, as I mentioned, with the headwinds in the office, this has really been counter-claimed by the fact that the office market rents as well as the cap rates have been compressing quite a bit, as well as the fact that the low interest environment has really driven the volumes in office space. And so I think this is going to continue to happen in 2021, especially as you see some opportunities, let's say even in the grade B space, to potentially fix it up. The fundamentals are still strong. There's a lot of good corporate bases in Tokyo markets. And of course, in some of the other more resilient sectors, we've seen some very strong performance coming out of logistics and multifamily. And we believe that the current year in 2021, that's going to continue to happen. Now, in terms of some of the unique trends that we're actually seeing, as we talk about commercial quite a bit, but in terms of just the pricing and the yield standpoint of different asset classes, one of the things that kind of strikes out in Japan is that if you look at it from a multifamily to commercial standpoint, and you look at global markets like North America and Europe, very resilient asset classes like multifamily, they tend to trade anywhere from 20 bips to 60 bip premium to what you would see in commercial, and mainly because of the strong defensive nature of these asset classes. But when you look at it from a Japan standpoint, even though the fundamentals of multifamily are very similar to the other markets in the global basis, you're actually looking still at about a discount of about 40 to sometimes even 50 bips to commercial assets. So we do think that there is definitely some room to run on a capital value standpoint, and these industries are going to continue to have some strength moving into 2021. Now, in terms of the playbook that we have for 2021, I'll start at the very top with multifamily. There's a lot of factors in multifamily that we like. For one, in terms of just the sector itself, it's a very resilient and defensive nature. If you look at the vacancy, or I should say the occupancy over the last couple of years, it's running about 95 to 96%. So from that standpoint, it's one of the most resilient asset classes. If you look at it also from just kind of the demographic viewpoint, you really start to see that there's a lot more households being formed with less sizes, smaller sizes, and these are getting driven into the city centers. So that demand in the city center locations is going to really continue. And we don't think that that's going to change in the foreseeable future. And then even from a more defensive nature in terms of delinquencies, the delinquencies in multifamily, especially if you look at just in 2020, it was one of the most defensive and resilient of all the asset classes. The delinquency was much better than what you would see in the commercial sector. So that, coupled with what we were talking about just a little bit earlier in terms of that negative spread of about 40 bips to commercial, we do think that this sector is a very attractive sector in the next couple of years, and especially coming in 2021, to the extent that we do have a product ourselves that will be coming into market the first half. So please stay on the lookout for that as we roll out that product in the next coming days and weeks. Now, the other sector we do like, and this is no exception to anywhere else, is logistics. But if you look at it from a Japan-specific standpoint, you look at the e-commerce growth over the last couple of years, these have been in double digits, and we anticipate that over the next couple of years, that trend is going to continue. And then in terms of a government support standpoint, trade support standpoint, the government recently has signed several trade agreements, not only within the APAC region, but also within some global context as well. And this should really boost the logistics sector in terms of warehouse and trade and so forth. So that's something that we definitely like from a demand standpoint. And so this is going to continue. I think one thing that we have to just be a little bit careful is there has been some supply into the Japan markets. The cap rates have moved quite a bit over the last couple of years. But nevertheless, to the extent that we find good opportunities, this is a space that we would like. Now, it goes without saying, when we talk about logistics and the growth of e-commerce, the next sector is obviously data centers and an alternative space of data centers. Japan is no exception. We like the space by itself just for the reasons I mentioned with respect to the e-commerce growth and all that. And so this is something that we will continue to chase after selectively. Now, the one thing about the Japan market that's a little bit different than, let's say, Australia and other markets is that there is a scarcity value in the land that has actual supply that will be appropriate for the data center. So it's not as easy to just go out and buy a piece of land and build a data center. But that also brings opportunities to the extent that one can source the right product with the right power supply. So we'll continue to look into that space during this year. And then finally, just kind of from an opportunistic standpoint, obviously with the low interest rates, you're not going to see too much distress, but there is going to be targeted distress. So if you look at markets and products like hospitality and retail, hospitality has been significantly overbuilt. Obviously, there was the Tokyo Olympics that were supposed to happen last year. Those are going to be markets where we do see that if the current conditions continue, there may be some opportunities to take advantage of the distressed situations. And then for retail, obviously, it's not a really favorite asset class, but within the ARA franchise, we do have quite a bit of retail. And we're confident in the fact that in certain retail, such as non-discretionary, these are sectors that we feel if we can go in there and it's well located, we can potentially reposition it for better uses within the retail sector. So I'll end that conversation on Japan for now, and I'll turn it over to Anthony for Korea.
Thanks, Stephen. I'll now present on Korea. At the macro level, Korea has remained quite resilient and has fared relatively well compared to its peers in the region and also globally, despite the COVID shock in 2020. The GDP did shrink by about 1.4% in 2020, but when compared with some of the numbers coming from the peers, that was not such a bad outcome for the year. The economy is expected to grow by 2.9% in 2021. The KOSPI, which is the main board index in Korea, has been repeatedly hitting record high levels since the end of 2020 and into the January and February of this year. So in order to sustain the economy and to induce prime recovery, the government has been actively introducing various subsidy measures, and the Bank of Korea has maintained the record low interest rate of 50 basis points since the early 2020. Turning over to the property market level, Korea has witnessed another record-breaking domestic transaction volume and also prices in 2020. This comes as the third consecutive year result. The total number of transactions was lower than that of the prior year, but there were several mega scale deals that got completed and which moved the needle last year, including the near $1 billion Park 1 deal, which was closed by ARA Korea in the last quarter of last year. And that particular deal was the largest commercial real estate transaction in Korea for 2020. ARA Korea was able to sell down the entire underwritten equity tranche well in advance of the original business plan. And the overall robust trend in Korea is firmly underpinned by an overflowing level of local liquidity, record low interest rate, and a heightened focus on the domestic market, as the local investors are mostly forced to look for investment opportunities onshore due to COVID limitations. We have also witnessed a clear trend of flight to quality, which in turn has led to bipolarization effect in both capital value and also in rental value as well. We're seeing an intensified hunger for quality core assets among the investors as they actively seek safe havens during this uncertain time period. Mostly driven by the record-breaking prices on core and core plus office properties in Seoul, we have seen the grade A office cap rate compressing down to about 4% range. In terms of the outperformers in 2020, the core and core plus office sector clearly topped the list with record-breaking transaction volume and prices, as investors actively sought after safe havens and stability during this volatile period. Also, the digitalization trend gained further accelerated momentum in light of the COVID pandemic. Thus, the e-commerce and IT-related sectors, including logistics and data centers, came under the spotlights in 2020. Lastly, the golf courses also traded very actively in this past year. Golf has been considered to be one of the safer and permissible forms of activities and social gathering in Korea during this COVID-19 environment. And that has translated into a high volume of transactions and record high prices for golf courses last year. On the other hand, in terms of the underperforming sectors and asset types, they were the hospitality sector, retail sector, and generally the inferior grade asset class across sectors. And they have suffered mostly due to COVID-19 social distancing rules and travel restrictions, and also the accelerated digitalization trend and the flight to quality trend, all witnessed in Korea. So in terms of the key considerations for 2021, the most obvious headwind and the issue remains to be COVID-19 and how effectively and quickly the government can control and suppress the virus through the pending vaccination program. Obviously, the sooner the social distancing rules and the travel restrictions can be lifted, the sooner the recoveries will trickle down to the SL level. However, for a more comprehensive and full-scale recovery, though, the domestic recovery will have to occur in sync with the global recovery, as Korea is very largely dependent on exports and also on tourism to a certain extent. Also, we have witnessed a recent spike in new office supply in one of the three main business districts in Seoul. And so we'll have to closely monitor and gauge how quickly those new supplies are absorbed under the post-COVID-19 environment. And lastly, we'll be keeping a close eye on the interest rate and the cap rate movements, as we are definitely in the record low levels in terms of both of those rates. Now, as for the opportunities in 2021, we'll continue to focus on the core and core plus office sector mostly. We do expect the flight to quality trend to continue and expect the high transaction volume and prices, especially in the office sector, to hold firmly, if not further increase in 2021. However, given that we are currently in a record low interest rate environment and also the low cap rate environment, where the risk premium or the risk-free rate has been very much thinning, So we definitely have to be very much more selective and conservative in our underwritings and focus more on the longer term fundamentals and prospects. Next, we expect the e-commerce and IT related sectors to continue to outperform in 2021, and thus we'll continue to seek opportunities in the logistics and data center sectors. On a related note, we'll also seek office assets in e-commerce and IT concentrated areas and districts that enjoy rising leasing demand. For instance, Pangyo Techno Valley, which is a newly created business district that is about 20 kilometers south of Seoul, has been enjoying a sub 1% vacancy rate for some time now, mostly backed by very strong leasing demand coming from IT industry firms in the area. By the way, ARA Korea has already invested in and also is managing 2 office towers in the area with a total AUM of over $600 million. And we are looking to increase our exposure in the area to an extent possible. Next, as hard asset prices continue to peak out in Korea, especially on core and core plus assets, we'll also be exploring development opportunities, namely in the office, logistics, and data center sectors mostly. In light of the COVID-19 shock, we have witnessed some of the underperforming asset types being converted into other uses. For instance, some of the underperforming hospitality assets being converted into resi use, and similarly, some of the underperforming retail assets being converted into office use. So although not a top priority item for the Korea office, we do plan to explore such value add conversion opportunities in 2021. Next, as COVID-19 fades, we expect outbound investment activities to pick up again and recover to at least, if not beyond, the pre-COVID-19 level, as local liquidity has actually been further enriched and investors are forced to actually look outside the borders of Korea in order to fully deploy their capital commitments. So the focus will be on the select core plus opportunities, mostly in the US and Europe. And in terms of sectors, we're likely to focus on office and logistics. And when assessing these outbound investment opportunities, we'll continue to closely monitor and engage FX hedge implications with a preference for destinations with yield premium effects. Lastly, we expect the public REITs market to perform solidly in 2021, both in terms of share performance and also in terms of new REIT IPO activities. Since the REITs have had bottomed out around March of last year, they have largely recovered and have been trading very stably since then. Last year, we did see 6 new REIT listings being successfully completed despite the COVID environment. And we do expect at least the same, if not an exceeding number of new REIT IPOs being completed this year. And investors can explore REIT IPO as an alternative exit strategy and also explore possible pre-IPO warehousing opportunities in Korea. ARA Korea is actually currently preparing to launch a new listed REIT in the latter part of this year, using an existing office portfolio as seed assets. With that, I'll turn over to Alvin for update on China.
Thank you, Anthony. Thank you. So China is commonly acknowledged as having one of the best containment, COVID-19 containment measures globally. They are still troubled by sporadic outbreaks, but they have become very efficient at managing these. And for the most part, their economy is able to function at close to normalcy. So this has translated into positive GDP growth, 6.5% for the fourth quarter 2020 and 2.3% for the entire 2020. So China is one of the few developed countries in the world to show positive GDP growth. But this show of positive high-level numbers actually belies a very challenging environment for real estate. An uneven recovery and the national strategic need to deflate residential real estate prices have compounded oversupply issues in retail and office. We feel that we're actually in a structural downturn, which will last for at least the next 2 to 3 years. If we use Shanghai and Beijing office as a barometer, the vacancy for Shanghai office is currently at 22% and is heading up to above 25% by the end of this year. Beijing is faring a little bit better at 17% currently, but is also forecast to go to go just below 25% by the end of 2022. So these are pretty dim occupancy rates compared to anywhere else in the world. We think China office can be viewed as monopolistic competition. You mostly cannot differentiate yourself enough to have a distinct pricing advantage. So the next 2 to 3 years will be challenging for everyone. China retail, on the other hand, relies a lot more on asset management and location differences. So we actually have a wider scope to swim against the tide. And so retail in China is really segregated into the winners and the losers. You have shopping malls in China where there are no shops above ground floor and the basement. At the same time, you have shopping malls in China where there are shoppers queuing outside every shop or most shops, and restaurants on the weekends. So generally, if we were to delve into China retail, there are two kinds of successful retail malls in China: the regional transport-oriented experiential malls, as well as the suburban necessity malls. So our retail malls in Shanghai CenturyLink and Dalian Roosevelt Plaza falls in the first category. Shanghai CenturyLink sits atop the intersection of 4 metro lines and sees an average crowd of 180,000 per day over the past 2 weekends. So there's just a lot of people at this mall. For Dalian Roosevelt Plaza, which is a 140,000 square meter mall in Dalian, it sits atop the intersection of line 1 and line 2. And for the last 2 weekends, it's been seeing a crowd of 130,000 each day. So occupancy for Dalian Roosevelt Plaza is holding firm at 95% levels, and average passing rent across the entire 2020 is down about 8%, right, amidst recurring bouts of COVID in Dalian. So all in, I think that these 2 malls have performed fairly well. But at the same time, you have to note their exceptional connectivity and the location. And on the second category of potentially successful malls, the suburban necessity malls, as an example, we bought Sanling Suntec Place in December 2019, right before COVID. One of the key investment theses that we had then was that there was a population catchment of 400,000 around a 3-kilometer radius, and there were no competitor malls within this 3-kilometer radius. So come year 2020, COVID year, tenant sales for the entire year was down by 9%, which was not too bad. But shopper traffic and sales, if you compare Jan 2021 versus Jan 2020, it was tenant sales was up by 6% and shopper traffic was up by 10%. So the suburban necessity mall investment thesis actually held up quite well. So to summarize on capital values, we are confident that our assets in China can hold up in capital values because we are performing at pretty close to pre-COVID-19 levels. I think that's the same for most of the well-located and well-managed assets across China. But for the assets that are not generating positive cash flow and they do not have a differentiating factor or appeal, we think there's going to be pain and repricing to their valuation. So moving on to logistics and data centers, as my other colleagues have mentioned, these 2 sectors are favored globally. But for China, there are further attractive government policies that make it even more so. First off, the upcoming China China Infra REITs framework includes logistics and data centers as assets that are REITable, and the commercial real estate is excluded in this initial first phase. So the China REITs are expected to come out in the second quarter of 2021, and we are hearing that logistics assets can be injected at a cap rate of somewhere between 4.75% to 5.25%, and data centers assets somewhere between 6.75% and 7%. Secondly, CBIRC announced lending cap limits to the banks right before the turn of the year on the last day of 2020. And these lending cap limits, again, do not include logistics and data centers. So for these two reasons specific to China, we think there will be broad investment demand, as well as making it much easier to secure financing for this category of assets. On the third point of distressed opportunities, we've been hearing about unsustainable debt levels, as well as unsustainable residential prices in China for some time now. The Chinese government is very determined to rein in residential housing prices, which they hope will direct capital into their capital markets, as well as to spur domestic consumption, both of which are critical points for China in the long-term struggle with the United States. So the introduction of the 3 red lines to force the leveraging of Chinese property developers, as well as I mentioned earlier, the property loan caps on the banks, combined with the oversupply situation, will lead to more distressed opportunities coming out in the next 2 to 3 years. We're already seeing a lot of pain in the sector in the last 6 months, and we think 2021 is a good time to start picking cherries. So turning to where we think the opportunities are for China in 2021, a similar theme as my colleagues have mentioned, we think given the forced deleveraging theme, as well as the drying up of capital to the real estate sector, we think mezzanine and pref equity type of financing backed by quality real estate assets provide attractive risk-return matrix. Sometimes this entails ARA bringing in senior banks to provide a lower cost financing package to the borrowers, leaving more for the mass piece. So depending on individual deals, we target a return of somewhere between 12 to 16% per annum for our investors. As an example, we provided a financing secured by 13 strata floors of office in Beijing CBD. We were able to generate a return on 14.4% for investors. The financing has since been repaid. So I think this strategy has attractive risk-return matrix, and we will lend against asset which we are comfortable owning. It's a loan to don't mind own strategy. And then for the favored logistics and data centers sectors, we are partnering up with proven operators to raise funds. For logistics, we are partnering with Logos, a logistics arm, which has 2 million square meters of leasing space in China. For data centers, we are actively reviewing deals and partnership with a few players, and we should be able to close a couple of deals this year. The barriers to entry for data centers in China is fairly high. We're definitely not late, and we think with our scale, we should be able to catch up very quickly. On distressed commercial real estate, both office and retail, we're looking to purchase a few assets off banks' bad books, as well as the AMCs and highly indebted property developers. We feel we're in a unique position to underwrite and capitalize on such opportunities, given our owner-operator model and the more than 600 people we have on the ground doing property management in China. So on these distressed assets, we can work it to somewhere between 8 to 10% yield on stabilized costs, and achieve a return of somewhere between 16 to 18% IRR, going from a distressed pricing to market price. So rounding up on China, I think the environment is going to be fairly challenging in the next 2 to 3 years, and of course that throws up attractive investment opportunities. But in the medium to long term, we remain very positive on China real estate. There are a few factors underpinning our confidence. These include rising consumption, the unlocking of onshore investment demand and investment products. There's also significant room for the risk-free rate and lending rates to compress, and of course the eventual internalization of the RMB. With that, I'll pass it off to Stephen to cover off the remaining markets of Singapore and Hong Kong.
Thanks, Alvin. I'll just spend a couple of minutes talking about Singapore, and then I'll round the corner to Hong Kong. I think when we talk about Singapore, there may be some pretext necessary to just kind of give the overall landscape. So Singapore itself is a fairly small country, and I think based on what had happened last year with COVID, the Singapore government really did a commendable job with respect to being proactive and getting ahead of the curve in implementing strict measures. And because of these measures, it really allowed the economy to at least stabilize and be prepared to hopefully what we like to think in 2021 have a good recovery, and also to keep the cases low. Nevertheless, if you look at the actual performance in 2020, in terms of a real estate standpoint, transactions were definitely down year over year in 2020. And if you look at from a GDP standpoint, it obviously took a significant hit as well. But I think it was really something where, because of some of these measures that I was talking about, the first half of 2020 was really kind of a touch and go situation. A lot of governments forced companies to close, retails were closed, and there really just was almost zero activity from not only the investment sales standpoint, but also from a leasing standpoint. But what we really saw is in the second half of 2020, we really just started to see some pickup in activity, not only on the investment sales, but also on the leasing side. There were several large, over 100,000 square foot spaces, tenants that had taken up space. Our building was a nice beneficiary of some of these demand in leasing spaces in Singapore. And I think that really boded well in terms of the recovery, and also just kind of the testament as when things come back, a lot of these companies were looking to go to places where they felt it was going to be a transparent market, it was going to be a resilient market. And I think Singapore checks a lot of those kind of boxes. So if you look at it from an overall capital market standpoint, I think those are going to be something where, if you look at the values of some of these trades that I just mentioned, some of these trades were really, from a price per square foot standpoint, trading at historical highs. And so I think, again, that is also something where most of these buyers coming in are probably viewing it as a positive with respect to the fundamentals. And I'll get into that in a little bit here in terms of some of the areas that we like in 2021 in more detail. But if you look at real quickly on some of the other asset classes, I think retail did take a hit, just given the fact that we have, fairly closed borders, the fact that the government didn't allow a lot of tourists to come in, or any tourists to come in, that really took a significant hit into the retail markets. And then once you factor in, let's say, some of the work from home initiatives and so forth, I think the retailers really took a hit in 2020. I think eventually it will start to come back a little bit, but I think in the short term, there's going to be continued headwinds into that particular sector. Now, I touched on it briefly. I think some of these initiatives that the government mentioned and enacted in terms of trying to get the economy moving, it's going to pay dividends in 2021. So if you look at the forecast for GDP, you're looking at almost a 5.5% recovery on the GDP in 2021. And that's going to bode well, not just for real estate, but across the sectors in Singapore. And that's going to also, really kind of affirm the markets to the international capital as well. So I'll get into a little bit now some of the things that we'd like to see and we'd like to do or implement in 2021. Kind of at the top of the list is office. So this is something that we've been pretty bullish on over the last 12 to 18 months. And I think this story continues to kind of play itself out. If you look at just from a historical supply standpoint, over the next 3 to 4 years, you're going to be looking at very low supply relative to historical averages. That's obviously going to bode well in terms of the supply-demand balances. As I mentioned, we continue to start seeing the demand from a tenant standpoint. If you look at the forecast of a lot of the brokerage houses over the next couple of years, there's going to be positive growth over the next 3 to 4 years. I think JLL came out with a report earlier this year where they predicted Singapore office to be the highest capital value and rental growth rate in the entire APAC markets. So I think that's going to be something where we continue to see a lot of momentum, not only for potential core buyers, where obviously it makes a lot of sense, but even from a value add standpoint, there's enough levers in the market right now that we think that if we were to buy a good, well-located asset, there's going to be opportunities to turn it around, and then demand will be there with a better, improved product into the marketplace. Now, the other markets that we do like is the alternatives data centers. Now, a couple of statistics I just want to kind of point out a little bit to kind of support the data center market in Singapore really is, from a digital economy, digital transformation standpoint, there's about $8 billion that's going to be attributed to digital economy in 2020 alone. And that was several billion dollars more just a year or two ago before. So, I mean, this is something where Singapore is really taking the lead as well in this region in terms of digital transformation, e-commerce, obviously, the likes of Lazada having their headquarters here and so forth. But so that's going to continue as well. If you look at the public cloud market, this market alone is going to be about 2.5 billion by 2025 in the Singapore market. Singapore is also leading the way in terms of 5G rollout, and then the IoT, the Internet of Things, that's going to continue to grow. Now, so I think if you look at it from a just a future demand, and is there going to be demand for data centers? You know, one of the very large global data center operators recently put out a report or a survey globally to see which markets are going to be the fastest growing. And sure enough, Southeast Asia came out at #1 with respect to, you know, future demand and the fastest growing area for data centers, of which 60% of that is actually attributed to Singapore. Now, some of the things that we have to be a little bit cautious, or just some things to note about the data center markets in Singapore, is right now, because of the land shortage and land supply, the government actually has a moratorium on data centers. And so that's going to be something that we have to balance, because right now with data centers, they take up a lot of supply, they take up a lot of energy with respect to how you operate those assets. So we do think in terms of opportunities that we're going to try to target, at least in the Singapore market for data centers, it's really going to be a hybrid combination of, can we find the adequate amount of power for a data center site, but complement that with sustainability measures, whether it's solar, ESG, those kind of things. I think that's going to play a role in terms of whether the government itself is going to grant approvals to do data centers. And so that's what we're going to be on the lookout for. And again, no exception to Singapore, logistics is another market that we do like. I think logistics, however, in Singapore is a little bit unique. I think most of you, or some of you may know that given the way that the land is set up in terms of the government ownership of most of the land for logistics, they tend to be on short tenured land leases. And so you're not going to have that phenomenon necessarily in Australia, where you get those longer term whales, which is really attractive to the core buyers. I mean, right now, because of these shorter term whales, you're not going to see as much long-term tenured logistic whale products in Singapore. And so recently, there has been quite a bit of supply into the market. But what we do like about logistics is that if you look at the forecast over the next 3 to 4 years, there's actually going to be a significant pullback in the supply. So on the 10-year average, we're going to be averaging about 1.5 million per annum in terms of new supply, and that's significantly less than about the 4.4 million that we have seen kind of on average over the last 10 years. So that is really going to help take up some of the absorption and some of that supply that has been in the marketplace. And I think that's going to be obviously bodes well for that market if you can find the right assets to find. And so from that standpoint, on the rental standpoint, again, based on the rents that we see right now, rents have really stabilized. They're now at kind of pre-COVID levels. So a lot of things are going in the right direction. But again, where we're going to focus on is really going to be focused on those modern warehouses, where we think from a long-term perspective, it's going to have that sustainability to make sure that it lasts into the future and future-proof the assets just from the amenities that it offers. And also even into some of the more niche logistics like cold storage. Singapore is right now kind of pegged to be the vaccine destination or distribution hub in this region. So that's going to be something in play as well. And then kind of like for all the other markets, there is one play from an opportunistic standpoint that we'll continue to monitor, and really that's the M&A and the REIT privatization. So Singapore itself is one of the largest REIT markets in the region with respect to listings that are going to be focused directly on this region. And historically, what has always happened is that the NAVs are always trading at a fairly large discount to the actual asset values. We've seen, obviously, as I just mentioned, the asset values have held up strong, but in a lot of cases, for whatever reason, the NAV is trading at a discount. So to the extent that we at ARA actually have that benefit of the public markets as well as the private market expertise, we're going to continue to monitor that space to see if there's kind of some arbitrage opportunities for some take privates and so forth. Because I think from a capital standpoint, at a certain point, these discounts to valuations, depending on if the manager is running into any kind of distress on the leverage levels, they could bring some opportunities. So I'll end the conversation on Singapore for now, and I'll move quickly into Hong Kong. Unfortunately for Hong Kong, there's going to be continued headwinds into the marketplace, not only from the traditional standpoint in terms of the supply and the demand of kind of what's going on with the social unrest, the COVID. Those are things that are going to just have a lot of impetus for people to be a little bit skittish on that particular market right now. If you look at the economy itself, it's in record recession, 16-year high on the unemployment. And so I think for a lot of the investors in the marketplace, it's kind of a wait and see situation. If you look at transactions that happened in 2020, almost 100% of the transactions were done by local buyers or China buyers who, this is their backyard. They're very familiar with it. They really don't have anywhere else to put their capital. So they're going to be, deploying into that market. So again, it's really a bit of wait and see in the Hong Kong market. But do we think that the market itself is going to fall off a cliff overnight? No, I don't think that's the case. But it is something that I think we just need to monitor and see if there's going to be some areas of stabilization. So if you look at it just in terms of some opportunities, the market itself, if you look at Hong Kong, it's still a very, very dense economy, dense population. So when you look at product that may be able to benefit from that, obviously well-located community retail centers that are able to kind of take advantage of the amenities that it offers to the community, and if you can get a good pricing, those could be some areas that we like. But overall, I think in 2021 we're going to maintain a very cautious view on the Hong Kong markets. But I guess in terms of just a couple of things that I'll just highlight that could be interesting is residential. This is something that we've also been harping on over probably the last 12 to 18 months in terms of a potential attractive asset class. I don't think that story has changed any much. I think there may be some questions with respect to foreign demand, but in terms of just the overall demographics and the lack of space and the affordability factor in Hong Kong, that is going to continue. And so to the extent that we can find opportunities that make sense, that could be one area. And obviously distress is another area that we'll look at. If you look at the actual distress in Hong Kong, there actually hasn't been too many. A lot of the owners in Hong Kong have been long-standing owners. They don't have much leverage or debt on the product. So there's really not that much distress. But if these continued headwinds happen in 2021, ultimately, I would think that there may be some cracks showing and some distress into the marketplace. So we'll continue to monitor that. If you look at some of the asking prices that are happening in Hong Kong right now, you're starting to see for the first time that some of these asking prices are actually dropping. And I think people are getting a little bit more accustomed to the fact of the new reality on pricing. And then finally, not necessarily Hong Kong per se, but the Greater Bay Area is something that we know that the China government from Beijing is very hot on. To the extent that you don't want to ever bet against the government. I mean, this is an area that our strong China team is monitoring very carefully. And to the extent that we can kind of leverage, not only the Shenzhen, Guangzhou markets, but if we can kind of tailor into some type of dual strategy with Hong Kong, then those are opportunities that we think may be interesting in the year ahead in Hong Kong. So I'll end it at that for Hong Kong and Singapore, and I'll turn it over to David to wrap up and open up to Q&A.
Sure, thanks, Stephen. I know the hour is approaching, so if we were to summarize what our panelists said, I think logistics resonates across the board, but in terms of certain unique opportunities, in Australia and China, credit opportunities abound. Distress situations in Hong Kong seem to be something that we need to keep and watch out for. And then office in Singapore and Korea, especially the long WALE offices in Australia, seem to be favored. And the multifamily in Japan, given the stickiness of the cash flows in the asset class, are also desired. And this is one of the reasons why ARA will be launching a pan-regional core plus fund that covers these markets, the increased desire for certainty in cash flows. So if I were to quickly delve into a couple of the Q&As while we still have time, maybe the first one I'll direct it to Stephen with regards to one of the panel questions. Basically, Stephen, how will the work from home trend in Japan impact the multifamily sector, especially in city centers?
Yeah, I mean, I think that's actually going to be viewed quite positively. I mean, obviously, if you work from home, you got to be working somewhere else. So the demand for rental housing is still going to be strong. If you look at what we're targeting with respect to multifamily as well, these are going to be much smaller units. They're going to be families are not going to be very large. I think one can have an argument that if you're working from home, you're going to be staying farther away. You're going to be staying in houses or whatever, and there's not going to be much demand. But for a lot of the sectors and the asset class of the multifamily that we're looking at, it's really going to be those young couples with either one child or no child that really want to be in that city center for their personal livelihoods and so forth. And so it's from that standpoint, given the fact that they want to be working from home or they need to be working from home, you know, a lot of the asset classes and the product that we're looking at right now, they're going to be forward commitments. So they're going to be brand new products. They're going to have a lot of the bells and whistles with respect to breakout areas and community rooms and those kind of things. So at least in terms of how we're looking at multifamily in Japan, we actually view that positively. And with that said, though, you know, Japan is going to be one of these markets where the employee base is really, they really like to go to work. And so I think this is something where either from that standpoint, I think it's going to be beneficial, though, for the multifamily.
Okay, thanks. Similar vein of question to Anthony, in terms of basically the interest in the increased interest in core office transactions sold, is there an expectation as well on working from home? And is there a view on potential increase in vacancies or a drop in NOI?
Yeah, generally speaking, the effect on the office usage in Korea, a change in office usage in Korea has been, relatively speaking, more limited, in my view, relative to some of the other countries. There has been some work from home schemes being adopted by some of the local companies as well as foreign companies based here. But I think that was mostly the case at the outset of the pandemic. But I think most of the companies have reverted back to not complete normalcy, but near normalcy, with limited work from home schemes or some sort of flexible work scheme with the consent of their supervisor and so forth. Having said that, if we kind of actually go back to the actual data and look at the actual numbers that got recorded at the end of 2020, actually the numbers came out actually very strong on the office demand. And also in terms of vacancy, we did see a spike in some of the districts towards the end of the year, but it was not related to lessened demand. It was actually more linked to new supply, large volume of new supply coming out onto the market in certain districts. If we just look at the demand, actually, there was a positive net absorption last year for the whole year of about 30,000 pyong. So, and also the effective rent actually increased by close to 2% in 2020. So in my view, I think it may have some effect in certain pockets of certain sectors, but generally speaking, I think what's been affected negatively in certain industries are also positively set off. For instance, we are definitely seeing a higher demand building up by the companies involved in IT or e-commerce industries. So like I mentioned before during my presentation, we're seeing in the Pangyo area, which is heavily dominated by IT firms as key tenants, their vacancy rate is sub 1%. And that's been the case throughout the whole, pretty much the entire year of 2020. So overall, I'm not so pessimistic on the ultimate effect on the rent and the vacancy. I think the market will eventually hold and hold firm over time.
Great, thanks, Anthony. I do believe that's all the time we have today, but again, thank you all for your time. After the session, we will circulate the recording and the materials. And of course, please do feel free to reach out if you do desire a one-on-one meeting or session on any of the topics that we've covered today. We'll be happy to get any of our panelists on board to discuss. Thank you all once again.